Hello, welcome back guys. In this video we're going to take a look at a company that I consider to be very interesting. That's Micron Technology. And it's obviously a semiconductors company. It's in a competitive space, of course, but it's a company that has been dropping quite significantly lately, about 40% down from its one-year high. And so it's currently sitting at 59, almost 59 bucks, and a $66 billion market cap. We're going to examine the company for what it's worth in terms of its financials and see whether it's a potentially interesting opportunity. It is definitely a company that I want to have in my portfolio, but at the right price. Which price is that? We're going to examine just now. Now, if we take a little bit of a look at what the company has been doing, you will see that it has been a high flyer, and recently, due to the pretty much overall market slump, it's going down, as it's happening with the majority of companies, if not all of them really. And so, maybe apart from oil. But yeah, overall companies seem to be going down, and this one does go down as well. And you will see here that the P/E ratio of the company has been dropping significantly, and it used to be relatively low, but now it's sitting at 7.48 here, with its price to free cash flow ratio though being significantly more elevated than its price to earnings ratio. We will examine what is going on over there and why the profitability doesn't really reflect the free cash flow here, what's happening. Now, the outstanding shares are about the same, just a little bit extra, but not a big deal. And total liability to free cash flow is also very acceptable here, sitting at 6, meaning it would take about 6 years of last year's free cash flow to pay back all the total liabilities that the company has, which is more than enough, more than fair. And the revenue growth of the company is solid, nothing too extraordinary here, but still pretty solid. Same with the net income growth. It's only the free cash flow growth that it has been going down a little bit. Hence, this is why we're seeing this price to free cash flow ratio here, which is elevated, I assume. And we'll examine, of course, the finer details there. The total equity has been growing for the company without them issuing too many extra shares. That's good to see. And they don't have a lot of debt. Now, the net income margin is amazing here, sitting at almost 29%, and it's been increasing lately. So this is very nice to see for the company. And the return on equity is sitting at 20%, which is also fairly solid over here. Very interesting to see also that the company's price to book ratio is rather low, and even if you see this being red, this is red because it has a default of 1, but this doesn't mean that the company has a bad price to book ratio, especially if it's that great of a company and it's a company in that space. You would expect this to be higher. So 1.4 is very solid here. And I also like that they are paying little dividends. I'm not a huge fan of dividends, but also the free cash flow payout ratio is very little here. We can kind of take a look at what's going on with the dividends of this company here. They seem to have been increasing it a little bit lately, but still it's sitting rather low. And I personally kind of like that. I'm not a huge fan of dividends. They're tax inefficient, and so I don't prefer them. So just paying a little bit here is okay. But if they would pay more, I would consider it in a much different way. Now, if we take a little bit of a closer look at the income statement of the company, income statements that is, you will see that they have been increasing the revenue from 20 to 27 billion, almost 28 here, which is fairly solid. And if you take a look at their net income, from 5 billion to 5.8. Now, you would love to see more profitability, but it's still positive. Having some years where the company has actually slacked quite significantly here, this may be a little bit of a concern, because at some point they were doing 14 billion here. It may be beneficial to take a look at what happened there, what actually caused this massive decrease, massive decline in what the company was making. You can potentially find some information here in terms of what happened with the company, because the revenues seem to be pretty good as well. So as long as the revenues do not decline significantly, maybe the company used the money for general expenses, marketing expenses, and things of that sort. Could be some of the reasons why the company has actually spent significant money and the net income went down. Now, if we take a look at the balance sheet over here, you will see that the company's total equity here has been growing from 20 billion to 44 billion, and I absolutely love to see that the company has been increasing their total equity without increasing their debt as well, actually decreasing their debt here, which is pretty awesome to see here. And the retained earnings pretty much also increasing quite significantly here, as you'll see. This means that net income has been increasing pretty much overall every year, and this is sort of like a permanent account that denotes what has been the cumulative effect of the net income that the company produces every year. It's basically sort of like a sum of the net income that the company has been producing every year, pretty much. Very nice to see. And the cash flow statement here, you will see, of course, that the net income has been going down, yet the net cash provided by operating activities has been increasing, which is interesting to see. And what's happening here? So you will see that the company has been having quite some depreciation and amortization here in the amount of 6 billion, 6.2 billion, and this is obviously not a cash expense. This is deducted from net income because it is an expense, but it's added back to cash flow because it is not a cash expense. Now, it's important to realize that this has already been deducted from the net income, so you will see it in the profitability. And this kind of depreciation amortization will be taken into a consideration when we're using our stock evaluation tool, because it has been written in a way that actually takes into account these factors here, and you will see it when we get there. Now, the cash from investing activities, you will see that the company has been spending quite some in capital expenditures, very understandable for this kind of company. And in terms of the cash from financing activities, it's been in the negative, basically because the company has been repaying debt, which you'd love to see, of course, and also repurchasing some stock, as you'll see, another thing that you would generally love to see. Now, the free cash flow from 3.4 billion, it's actually down right now to 2.4 billion, while last year it was almost zero or close to that. Now, of course, it really depends on what we examined earlier in terms of the net income, what the company started with. But it doesn't look like it has been too much affected by the actual revenue that the company made. It mostly looks like some sort of a decision on how the company actually utilizes their profit, pretty much, or whatever would be profit if they didn't utilize it for marketing expenses and things of other operating expenses of that sort, potentially. Now, I do want to take a look at the stock evaluation tool, and we kind of need to take all these things into account here. But you will see that the revenue overall has been increasing, and you definitely want to take this kind of slump into consideration because it has been going down a little bit, and this is important. Now, profit, like net income, can be affected by all sorts of ways. Maybe the company even decides to do that, but revenue going down is problematic. Now, it has been increasing here, but because of this, you will see that the 5-year average has been 22%. I'm not going to go that high because, again, like the 3-year average has been negative, as you'll see here, because the company has been dropping quite significantly. I do expect that the company will be having much better revenue numbers, but I will go low. I want to see what's going to happen if I go low, like 8, 10, and 12 here. And the net income margins have been pretty much about the same, more or less, at least in terms of the average. This is what the company is getting. So I will go maybe, let's go 20, 22, and 24 here, see what we get, or maybe 25. And the free cash flow margin, now again, this can be a little bit all over the place because of the years that the company didn't do well. Like, for example, when they made 2.6 billion in terms of net income. I don't expect this to be their average. Their average seems to be something like this one, 40% or 50 or 60%. And this has a lot to do with the depreciation and amortization effect that we talked about earlier. And this is why it's important to have this kind of free cash flow here that is related to the net income, because now you know that profitability for this company is a little bit I'd say tedious in terms of how it's being used as free cash flow. It's a little bit like the profit that gets generated. It's not very effective compared to what it would be for other companies because of this depreciation and amortization effect. And it's good to know this brings down the overall free cash flow margins here, and we will take it down to 40, 50, and 60. Annual return of 13% is typically what I want to be making. And if I hit calculate, you will see that for our current price sitting at $59, we're very close to our medium estimates here. Now remember, I went conservative here. If I would go a little bit higher, this would definitely be green over here, and you will see that our high estimates, which are fairly fair, I feel, are actually green over here. So these estimates may be slightly aggressive here, but still I think they are within the realm of reality for sure, and they could very as well happen in the next 5 years. So what do I think about this company? I think it's a potentially interesting buy. I myself would like to buy such a company at a lower price, just because, again, the profit that these companies are making is not as effective as companies that are selling other things, for example, and have higher free cash flow margins, for instance. And also, it's a very competitive space, has a lot of very big competitors here. This is probably why you're seeing the revenue going up and down quite significantly also in some years. And so you want to be paying special attention, and maybe it's going to be better to get this at an even better price. So I think if it drops a little bit more, this would be a much better opportunity. Even here, it's not bad at all, actually. I mean, I could definitely see somebody owning this one and making some good money over the years. It's not bad at all. but I would love to get it at a little bit of a discount if possible. Now let me know what you think about this company. Please remember to leave a like and subscribe, and yeah, just leave a comment. Let me know in the comments below. I'm curious to see what you think about Micron. And thank you for listening and watching this video. I'll see you soon, guys. Bye bye.